Focus brought to you by IG, taking a look today at whether or not the Fed has lost control of interest rates. Now, of course, they control short-term interest rates, and in that short-term interest rate, they've been very, very active over the last 3 years. Going back to the pandemic, you'll remember that they had the overnight rate north of 1%, which now doesn't seem like much. But in 2020, you go back from the 2010s to 2020 there, and an overnight rate over 1% was actually kind of rare. They were closer to 0% than above 1% for the majority of that period. Now the pandemic hits in March of 2020, and central banks across the globe bring interest rates either near or at or below 0%. Of course, Bank of Japan has been negative since that pandemic, since the pandemic start, that is. And since then, of course, now the most recent trend has been higher interest rates, right? Inflation sparked in later 2021 and the start of 2022. And we've now seen the Fed hike interest rates from 0% from the pandemic all the way above 5%, where we currently sit. Now, where are they expected to go with the one interest rate that they control? Well, they're not really expected to do much else. There's only a 29% chance of one more rate hike, and those odds were closer to 50-50 a couple of months ago. We'll see if they do commit that one more hike, but as the market is currently presented, only pricing in maybe one more rate hike, and probably not even that, and not a lot of leeway to the upside there. Actually, market looking like they might cut interest rates in the next year here. And you might say, well, that's weird, because I'm hearing all this stuff about 10-year yields from the Treasury hitting 5% and, kind of moving higher and higher over the course of the last couple of months. And now you're telling me that the Fed is expected to potentially cut. Well, yeah, keep in mind that the Fed, one, only controls that overnight interest rate, and two, kind of the premise for today's show, they're kind of losing control or losing influence over the rest of the yield curve, which isn't a novel concept. There's very often times, we saw it actually as they were hiking interest rates in 2022 and the early part of 2023, the Fed was hiking to 3%, 4%, 5%, and Treasury yields across the curve were lagging behind. We've had an inverted yield curve because of this for the last 2 years. And now a lot of people wondering if they went too far, and now Treasury yields are either at or near 5% or above 5%, and maybe even moving closer to 6% in the coming months. We'll see what happens. But a lot of people wondering if the Fed has kind of lost control here. They went too far, and they're going to have to try to cut to influence the yield curve lower. And you can see here the market focusing the distribution of likelihoods for interest rates at the end of 2024, closer to 4.5%. And right now we're at 5.25%, 5.5%. And so market thinking that in the next 12 months, they are likely to cut by almost a full percentage point or 100 basis points. And again, just to show this dichotomy, you have the 10-year yield in orange, and then you don't have the overnight rate, but you have the closest Treasury yield to it, the 1-month bill yield in blue. And you can see that short-term rate close to the Fed's overnight rate that they control is kind of flatlined. It hasn't really moved higher since the summertime. And in that same time, 10-year yields have moved higher by more than 100 basis points. They've gone from below 4% to near 5%. And they're toying with the idea of rising past 15-year highs. And the Fed can't do anything about that because they don't control Treasury yields. Now, they set that overnight benchmark that influences yields. But the question now becomes, we've gotten inflation lower. We've gotten interest rates to the highest they've been in 15 years, which has helped to make the economy normalize a little bit coming off of the pandemic and the growth that we saw after the pandemic. And they're pretty close to that soft landing. Can they get that soft landing, or will they have to cut rates to try to move 10-year and 30-year yields that are making, houses and cars and all of these things so much more expensive? Can they get that soft landing, or did they go too far and the economy is going to turn over into a potential recession? Like I say, not necessarily in control of that fate. They have a great influence over it, but they only control that overnight rate. And I wanted to point out something that has been a really interesting trend, because I'm definitely one of the last people who would tell you, oh, that's a really significant level there in the S&P 500, or, oh, that's a support line or a resistance line. If you buy into that stuff, that's great. Much more, of the mind that markets can theoretically do whatever they want. Markets aren't necessarily cognizant of these big values, especially the S&P 500. Its value is an amalgamation of a bunch of stock prices, and whether it's $4,000 or $5,000, the value is relatively arbitrary. Now, that being said, 10 years being at 2% or 3% or 4% or 5%, not arbitrary values in the least. And I don't think it's any coincidence, and I've highlighted here over the course of the last couple of years, as the 10-year has gotten to 2% and 3% and 4%, and now nears 5% for the first time since 2007. What did that look like for the stock market? And I don't think it's any coincidence that you see when we hit 2%, the stock market hitting some lows for that time frame, making new lows when the 10-year peaked its head above 3% for the first time in the summer of 2022, and then in the fall of 2022, when stocks made their lows for the last couple of years here, was right around the time the 10-year hit 4% for the first time in the last several years. And now we're seeing stocks slip lower once again. Are they at the lows for the last couple of years? No, they're not there, but they're heading in that south direction. And 10 years are right there on the precipice of 5%. And we can see historically when 10 years have hit a new big level, they've traded through it. And that's coincided with some stock market selling. So we'll see what happens here. Do they back off 5% and the stock market picks itself back up? Or do we see a similar historical trend where it eclipses 5%? Maybe sends stocks lower. It's definitely worth noting that correlation there. Now, looking at the futures options market for 10 years, the chances that 10 years are above 5% at the end of this year are only 35%. And, that's high. That's higher than the chances that the Fed will hike again. But given that we're only, 15, 20 basis points away from 5%, they're not thinking right now that it's necessarily, close to 50-50 that will end the year above 5%, but very real. Definitely not an outside chance, not a 2 or 3 standard deviation chance that they get there. It's reasonable. Now, where we do start to get into that 2 or 3 standard deviation range, and I thought this was interesting because there is a chance, but it's not a very likely one, that 10 years get to 6%. Market not buying that quite yet. Now, these odds change every day with prices in the market, obviously. And I'm sure when we hit 3%, the likelihood of 5% looked really far away. But you can see here, haven't been to 6% in the 10 years since the really early aughts, right there in 2000, maybe not even 2001. And right now only seeing a 3% chance of getting there by the end of the year. And if we did get beyond 5%, closer to that 6%, it'd be really interesting for the stock market at that point. What it'd also be interesting for is the unprecedented run we've seen in US dollars. You'll remember when 10 years in that stock market low and new high for US rates of 4% near the end of last year coincided with new highs for dollar versus the euro versus the pound for the last 20 years or so, and the yen for the last 30 years at that same time in October of last year. And we're actually now trading above those highs that we closed at in October. That one day they closed above 150, trading recently above 150 and actually through 151. Dollar is against that yen piece, and dollar seeing more strength against the euro and pound and everything else. So, the Fed meetings for the foreseeable future will be really, really interesting, less for maybe the action. The market's not seeing them change rates one way or another for at least the next couple of meetings here. Most likely that they'll just hold pat. But I think it'll be more interesting for how the Treasury yield market, especially in the 10-year, it's a benchmark that a lot of people watch and a lot of stocks use for all their calculations, because that's how a lot of mortgages and car loans and everything else are calculated. Not something the Fed can control, but something that they can influence, and we'll see how that fluctuates, because it's very meaningful for the stock market and for obviously this US dollar market that's right there near its highs, depending on the currency you're looking at, with the highs in yields. So we'll see what the Fed does. Not likely to change what they can control, but a lot of this is out of their control.